Picture yourself as an explorer on a global quest, navigating the interconnected world of international economies, where each market holds unique opportunities and risks. Understanding the global economy and its influence on investments is like charting a course through complex waters, requiring both skill and knowledge. In today's journey, we'll delve into how the global economy impacts investments, explore the role of economic indicators, and look at strategies for international diversification. Join me as we unlock the tools and insights that empower investors to navigate the vast, dynamic world of global investing. Investing on a global scale requires an understanding of how different economies interact. The global economy is a dynamic system, with developed markets like the US, Europe, and Japan offering stability and predictability, while emerging markets, such as Brazil, China, and India, provide high growth potential but come with greater volatility. Developed markets offer a relatively safe haven for investors, as these mature economies typically experience slower, steadier growth. However, they are not immune to global economic shifts, such as changes in interest rates or geopolitical events, which can cause ripple effects across markets. Emerging markets, on the other hand, are often the engines of global economic growth, with expanding middle classes, increasing consumer demand, and infrastructure developments. But these markets also carry higher risks, such as political instability and currency fluctuations. Understanding these distinctions is key to building a diversified, resilient portfolio that balances risk and reward across economic conditions. In the vast global economy, certain indicators act as guideposts, offering insights into economic health and trends. Key indicators like GDP, unemployment rates, inflation, and interest rates provide valuable clues about the direction in which an economy is moving. Gross domestic product, GDP, is the broadest measure of economic activity, reflecting the value of goods and services produced within a country. Rising GDP signals economic expansion, which often boosts corporate profits and stock prices, while declining GDP suggests contraction, potentially signaling a recession. Unemployment rates serve as a vital indicator of economic stability. Low unemployment rates indicate a robust economy with strong consumer spending power, while high unemployment suggests weaker demand and reduced economic growth. Investors monitor these rates closely, as they can impact stock and bond prices. Inflation rates measure the rate at which prices rise, eroding purchasing power. Moderate inflation usually signifies a growing economy, but high inflation can hurt both consumers and businesses. To counter inflation, central banks may raise interest rates, which impacts borrowing costs and can slow economic growth. Interest rates set by central banks influence the economy's borrowing environment. Low interest rates encourage spending and investment, while high rates can cool down an overheated economy. Interest rates affect everything from consumer loans to corporate investments, making them a critical factor for investors to consider. These indicators help investors anticipate market shifts and make informed decisions, just as a captain uses navigation tools to guide a ship through changing tides. Trade relations are the lifelines of the global economy, facilitating the flow of goods, services, and capital across borders. Agreements like NAFTA or the EU's single market allow for smoother trade, boosting corporate profits and stock values. Conversely, tariffs, trade wars, or disruptions in supply chains can increase costs for companies, impacting their bottom line and affecting stock performance. Geopolitical events, such as conflicts, elections, or economic sanctions, can also create waves that ripple across global markets. An investor in multinational corporations or foreign assets must consider these factors. Understanding international dynamics provides a broader perspective, allowing investors to anticipate how foreign policies or shifts in trade relations might impact global financial markets. Technology is a powerful driver of economic growth, shaping the way industries operate and creating new investment opportunities. Innovations, such as renewable energy, artificial intelligence, and biotechnology, are transforming entire sectors, creating growth opportunities in industries poised for expansion. However, with rapid technological change also comes disruption. For example, advancements in renewable energy can pose risks to traditional oil and gas companies, while digitalization may render certain roles or sectors obsolete. Investors need to keep a pulse on technological trends, as they can both drive economic expansion and create investment risks. Being aware of these changes enables investors to capitalize on emerging sectors, while mitigating exposure to industries facing decline. International diversification involves spreading investments across various countries and markets to reduce risk and increase potential returns. Think of it as assembling a portfolio that includes not only domestic assets, but also stocks, bonds, and other assets from around the world. This approach helps reduce the impact of localized economic downturns on a portfolio, as economic conditions often vary from one region to another. By diversifying globally, investors can benefit from growth in regions experiencing economic booms while offsetting losses from regions in recession. However, investing internationally also introduces complexities, such as currency risk, regulatory differences, and geopolitical factors. A diverse portfolio that includes both domestic and international investments creates a buffer, allowing investors to spread risk while still capturing global growth potential. One of the primary challenges in international investing is currency risk. Exchange rate fluctuations can significantly impact returns, especially if a foreign currency depreciates relative to the investor's home currency. For instance, a U.S. investor holding European assets may see a decline in returns if the euro falls against the dollar. To mitigate this risk, investors use hedging strategies like forward contracts or currency-hedged funds. Forward contracts allow investors to lock in exchange rates for a future date, reducing exposure to unfavorable currency movements. Alternatively, currency-hedged funds incorporate hedging within the fund, offering a simpler solution for managing currency risk. Diversifying across multiple currencies can also lessen the impact of any single currency's volatility, making international investing a more balanced endeavor. Emerging and frontier markets are often considered the uncharted territories of the investment world. These economies, like those of India, Brazil, and Nigeria, present exciting growth prospects, as they are in the process of industrializing and expanding their consumer markets. Emerging markets offer significant opportunities for investors willing to embrace higher risk in exchange for potential high returns. They can be a lucrative addition to a diversified portfolio, providing exposure to rapid economic growth and consumer demand. However, emerging and frontier markets also come with heightened risks, such as political instability, underdeveloped infrastructure, and currency volatility. Frontier markets, which are even less developed than emerging markets, carry additional challenges, such as limited market liquidity and regulatory unpredictability. Investors interested in these markets need to conduct thorough research, understanding both the opportunities and risks involved. By carefully selecting assets within these regions and maintaining a diversified approach, investors can balance the high potential returns with the risks associated with these rapidly evolving markets. For those looking to invest internationally, there are several types of investment vehicles to choose from. Direct foreign investment. Purchasing foreign stocks or bonds directly offers direct exposure to international markets. However, it requires an understanding of local markets, tax laws, and currency risks. Mutual funds and ETFs. Many funds offer exposure to international markets, allowing investors to invest in diversified portfolios of foreign assets. These funds can focus on specific regions or sectors, such as European equities or emerging market bonds, providing investors with both diversification and professional management. American Depository Receipts, ADRs. ADRs are a way for U.S. investors to purchase shares in foreign companies through U.S. exchanges. They provide a simpler alternative to direct foreign investment, offering exposure to global markets without dealing with foreign exchanges or currency conversion. Each investment vehicle has its advantages and is suited to different investor needs. The right choice depends on factors like the investor's familiarity with international markets, risk tolerance, and desired level of exposure to specific countries or regions. Understanding the global economy and its impact on investments allows investors to explore a world of opportunities beyond their home borders. By studying economic indicators, navigating trade and geopolitical dynamics, and leveraging technology, investors can build a well-rounded portfolio that captures global growth potential. International diversification, combined with strategies to manage currency and geopolitical risks, provides a path to a resilient, balanced investment strategy. Investing on a global scale offers both challenges and rewards. It requires a keen understanding of different markets, a willingness to adapt to changing economic landscapes, and the strategic use of various investment vehicles. With the right knowledge and preparation, investors can navigate the complexities of the global economy, discovering new opportunities and strengthening their portfolios for a prosperous future. The world of investing truly becomes global, opening doors to growth, resilience, and financial success across continents.